Good morning, everyone. Today we are moving towards the quantitative analysis of company. Basically, nothing but the analysis of the financial statement of a company. So, how to analyze a financial statement of a company? So, basically, this is a P&L account. The profit and loss account basically will tell you about the performance of the company during a particular year, right? So whenever you do the analysis of the profit and loss account, you basically needs to take into account a historical period and at least take a period of 5 years so that you understand the trend of the company, how they are growing basically in revenue terms as well as in the profit terms. So whenever you do the analysis of the financial statement, ensure that you take a larger period of at least 5 years past, so that you get a trend about the increase in the profit or growth in the revenue. So here we see that we have taken a 2-year period, and if you see here, the sales of a company is increasing from 80 to 100 crore, right? And to generate that kind of revenue, there will always be a purchases or other costs which a company has to incur to generate that revenue. So what are the costs? The cost is nothing but, so on the left side there are costs, on the right side there will be the income. So here you can see the cost of sales or cost of goods sold. Cost of goods sold is nothing but it includes your purchases cost. So whatever the company purchase, right, to generate the revenue or to generate the sales will be included in the cost of sales. The purchases cost plus the opening stock of whatever the goods which are there in the previous year. So why we are adding that in the purchases? Because that cost was incurred in the previous year, but that purchases have not been sold in the previous year. That means that costs have not generated the revenue for a company. Since that have not generated the revenue, we are forwarding that cost to this year, and then from that purchases we are going to sell this particular. We are going to generate the revenue from that opening stock. So from the purchases we will add the opening stock and less the closing stock. Closing stock is a stock which has not been sold in this particular year, and we are going to sell it in the next year. Since that costs have not generated the revenue for the company, we are going to deduct it from this year because it's already included in the purchases. So from that purchases, we need to deduct the closing stock of a company. So opening stock plus purchases minus the closing stock will give you the cost of goods sold, right? So we have just started now, and we have started with the P&L account of a company, which will tell you about the performance of the company during a particular year, that how the company have performed. So whenever you do the analysis, ensure that you are doing the analysis for at least for a period of 5 years to get a trend about how your revenue and the profits of the company is growing. So there is a sales which we see here. We are taking a 2 years period for comparison. Here you are seeing the revenue is increasing from 80 to 100 crore. To generate that kind of revenue, the company will also incur certain kind of cost. The first cost is a direct cost which a company have to incur to generate the sales, which is purchases cost. And the cost of goods sold also include the opening and the closing stock. So opening stock plus purchases minus the closing stock is nothing but the cost of goods sold for a company, which is also increasing from 60 to 78 crore. After deducting from the sales or from the revenue, the cost of sales, you get the gross profit, which is a top line item, a top line profit of the company, which is also increasing from 20 to 22 crore.